Warren has always maintained that financial crises don't arrive without warning, though most people prefer not to see what lies before them. Throughout decades of observing markets, businesses, and human behavior, Warren has reached a conclusion he considers fundamental. Crises are never truly surprises. They are the predictable result of patterns that repeat with almost mathematical regularity. What changes are the names, the instruments, the excuses, but the essence remains identical, generation after generation. Warren doesn't speak from academic theory or complex economic models. He speaks from the accumulated experience of having personally lived through the bursting of speculative bubbles, banking panics, collapses of confidence, and collective euphoria, followed by silent devastation. He has seen fortunes built over years evaporate in weeks. He has observed how intelligent, educated, sophisticated people commit the same mistakes their parents and grandparents committed before them. For Warren, there exists a recognizable pattern that precedes every major financial crisis. It's not about secret formulas or mysterious technical indicators. It's about common sense applied with discipline to the observation of collective behavior. The first signal Warren invariably identifies is the widespread conviction that this time is different. Those four words, for him, are perhaps the most dangerous in the financial vocabulary. Each generation believes it has discovered something new, a different way to create wealth that defies fundamental economic laws. In the 20s, it was rampant speculation in stocks bought with massive credit. In later periods, it was conglomerates, then technology companies without earnings, then mortgages packaged as complex financial products. The names change, but the illusion is always the same, that the old rules no longer apply. Warren has observed that when people begin justifying absurd valuations with novel narratives, when they start inventing new metrics to explain why expensive isn't really expensive, the crisis is already gestating. The problem isn't that people are foolish. The problem is that they want to believe. They want to believe they've found the easy path to wealth. They want to believe they can get rich without effort, without patience, without truly understanding the businesses they're investing in. The second signal Warren identifies is the expansion of credit beyond rational limits. For him, credit is like oxygen, essential in appropriate quantities, lethal in excess. When he observes money flowing with extreme ease toward increasingly dubious projects, toward increasingly unprepared speculators, toward increasingly complex schemes, Warren recognizes the same pattern that has preceded every major collapse. Easy credit has a narcotic effect on markets. It allows projects that should never be financed to receive abundant capital. It allows speculators without experience to feel like sophisticated investors. It allows asset prices to disconnect completely from their real value. And most dangerously, it allows this process to feed on itself for years, creating the illusion that the model is sustainable. Warren has seen how in every cycle, lenders begin with rigorous standards and end up lending to anyone who can sign a document. He has seen how requirements gradually relax, how exceptions become the norm, how prudence is considered old-fashioned. It always ends the same way. When the credit flow stops, the entire structure built on that artificial foundation collapses. The third signal is the massive participation of people who had never shown interest in financial markets. For Warren, when the taxi driver, the barber, the neighbor next door begin giving investment advice with absolute confidence, when everyone talks about the fortunes they're making, when investing becomes a topic of everyday conversation in places where it was never mentioned before, the bubble is in its terminal phase. It's not that Warren despises these people. On the contrary, he understands they are victims of a system that seduces them precisely when risk is at its maximum. But their massive entry into the market is symptomatic of something deeper. It means those who traditionally invest have already exhausted their capital and need new buyers to sustain inflated prices. It means the last group of participants is entering just when the first ones are looking for the exit. Warren remembers historical episodes where secretaries quit their jobs to speculate full-time. He remembers when people without any financial training considered themselves experts because they had made money for 6 months in a bull market. He remembers the collective euphoria, the sense of invincibility, the shared certainty that this would continue indefinitely. And he also remembers the subsequent silence when losses arrived and nobody wanted to talk about it. The fourth signal Warren identifies as the growing complexity of financial instruments. For him, complexity is not a sign of sophistication but of obfuscation. When financial products become so complex that even those selling them cannot explain them clearly, when incomprehensible mathematical models are needed to justify valuations, When structures have so many layers that nobody can trace the real risk, Warren recognizes the same pattern he has seen before. Complexity serves two perverse purposes. First, it hides the real risk under layers of technical jargon and mathematical modeling. Second, it allows charging astronomical fees for products that are essentially simple but presented as revolutionary. Warren has observed how each crisis reveals that behind the apparent complexity were basic assets of poor quality, ingeniously packaged to appear safe. His philosophy has always been the opposite. If you cannot understand a business in simple terms, if you cannot explain why it has value in one clear paragraph, you probably shouldn't invest in it. Unnecessary complexity is usually a sign that someone is trying to sell you something that wouldn't withstand honest analysis. The fifth signal is the gradual disappearance of skepticism. Warren has noticed that in the final stages of a bubble, those who express caution are ridiculed. Skeptics are considered outdated, bitter, envious of those who are seizing the opportunity. Voices of reason are silenced not by solid arguments, but by the crushing weight of euphoric consensus. For Warren, this is perhaps the most dangerous aspect. When prudence becomes an object of mockery, when patience is considered cowardice, when waiting for reasonable valuation is seen as missing the opportunity, the system has lost its natural correction mechanisms. Healthy skepticism is like an immune system. Its absence allows disease to spread unchecked. Warren has lived through moments where his decisions not to participate in obvious bubbles were publicly questioned, where his insistence on reasonable valuations was seen as a sign that he had lost his touch, where his discipline was interpreted as inability to adapt to new times. And on each occasion, time eventually confirmed that discipline, not euphoria, was the right path. The sixth signal Warren identifies is the proliferation of get-rich-quick schemes. When he begins seeing mass advertising promising extraordinary returns with little effort, when gurus appear claiming to have discovered secrets that traditional experts ignore, when seminars, courses, and systems guaranteeing easy wealth multiply, Warren knows the final phase is near. These schemes exploit two fundamental human weaknesses: greed and impatience. They promise exactly what people want to hear, that they can get rich without the hard work of understanding businesses, without the discipline of waiting patiently, without the boredom of serious investing. And because people want to believe, thousands fall into the trap. Warren considers that genuine wealth, the kind that is built and maintained, is the result of decades of prudent decisions, not months of fortunate speculation. But that truth is unattractive in the midst of euphoria. Nobody wants to hear that the right path is slow when the neighbor is apparently getting rich overnight. The seventh signal is the explosion of valuations that defy any basic economic logic. Warren has seen companies without earnings, without a clear business model, without apparent competitive advantages, reach valuations superior to established companies with decades of proven track record. He has seen assets whose price multiplies by 10, by 20, by 100, without any fundamental justification. For him, price must eventually reflect value. It can disconnect temporarily due to collective psychology, but economic gravity eventually prevails. When he sees prices that can only be justified by assuming perpetual growth at impossible rates, when projections require everything to go perfectly for consecutive decades, Warren recognizes the collective illusion that precedes painful awakening. The eighth signal he identifies is the deterioration of ethical standards. In the late stages of bubbles, Warren has observed how collective greed erodes moral principles. Executives manipulate accounting figures. Auditors approve what they should question. Analysts recommend what they know is garbage. Regulators look the other way. Everyone is incentivized to keep the party going a little longer. Warren considers character as important as intelligence in business and investing. When he observes that character is being systematically sacrificed at the altar of quick profits, when honesty is considered naivety, when fraud is normalized as financial creativity, he knows the structure is rotten from within. The ninth signal is absolute confidence that authorities will prevent any crisis. Warren has noticed a pattern where, after each government bailout, the next bubble is even bigger. People learn they can assume irrational risks because if everything collapses, there will be a rescue. This certainty that they won't let it fall eliminates the healthy fear that should moderate speculation. For Warren, this moral hazard is one of the deepest problems of the modern financial system. When you privatize gains but socialize losses, when you allow speculators to get rich in good times but rescue their mistakes in bad times, you're incentivizing exactly the behavior that leads to crises. The 10th signal, perhaps the most subtle, is the disappearance of historical memory. Warren has lived long enough to see how each new generation ignores the lessons the previous one learned painfully. Young people who didn't live through the previous crisis feel immune to its lessons. They genuinely believe this time is different because they don't personally know the pain of the last time. For Warren, studying financial history is not an academic exercise, it's a vaccine against repeated stupidity. Whoever knows historical patterns can recognize them when they emerge again under different names. Whoever ignores history is condemned to relive its most costly mistakes. Warren has never tried to predict the exact moment when a bubble will burst. He considers that impossible and moreover irrelevant to his approach. What he does is recognize when prices have disconnected from reality and act accordingly, avoiding participation in euphoria, maintaining available capital, waiting patiently for sanity to eventually return. For him, successful investing during bubble times doesn't consist of predicting the collapse, but of having the discipline not to participate in collective madness. It requires being willing to look foolish while others apparently get rich. It requires confidence in fundamental principles when everyone is abandoning them. It requires, above all, patience to wait for the market to eventually offer genuine opportunities at reasonable prices. Warren has learned that crises, however painful, fulfill an essential function. They clean the system of accumulated excesses. They destroy illusions. They eliminate unsustainable business models. They punish irresponsible speculation. And eventually, they create extraordinary opportunities for those who have maintained discipline during euphoria. From his perspective, whoever understands these patterns and acts with discipline need not fear crises. On the contrary, they can see them as a natural part of the cycle, like winter that inevitably follows summer. The question is not whether the next crisis will come, but whether you'll be prepared when it arrives. Preparation is not a matter of perfect timing or complex strategies. It's a matter of not doing foolish things when everyone around you is doing them. It's a matter of maintaining standards when everyone else abandons them. It's a matter of remembering that gravity exists even when it seems temporarily suspended. Warren has always believed the signals are there for whoever wants to see them. The problem is not that they're invisible, but that most prefer to ignore them, because accepting them would require acting contrary to euphoric consensus. It would require saying no when everyone says yes. It would require selling when everyone buys. It would require waiting when everyone acts. That is the essence of his philosophy regarding bubbles and crises. It's not about being smarter than others. It's about being more disciplined. It's not about predicting the future. It's about recognizing the present with clarity. It's not about completely avoiding losses. It's about avoiding permanent losses of capital caused by avoidable mistakes. Throughout decades, Warren has seen these signals appear again and again. He has seen how greed systematically defeats reason in the minds of crowds. He has seen how fear of regret for missing the opportunity overcomes rational fear of loss. He has seen how obvious patterns are ignored because recognizing them would require sacrificing short-term gains. But he has also seen how those who maintain discipline, who resist the temptation to join the crowd, who understand that serious investing is boring by nature, are eventually rewarded. Not immediately. Not with the fanfare that speculators receive in good times, but consistently, sustainably, cumulatively. Warren considers that the greatest advantage in investing is not superior intelligence or access to privileged information. It's the ability to control one's emotions when everyone around is losing control of theirs. It's keeping a cool head when the environment is overheated. It's remembering fundamental principles when they seem irrelevant. Financial crises, from his perspective, are not system failures but system features. They are the way markets correct excesses accumulated during periods of euphoria. They are inevitable because human nature is constant. Greed and fear will continue alternating as long as markets exist. What separates successful long-term investors from speculators who eventually lose everything is not the ability to avoid crises, but the ability not to create personal crises during good times. It's avoiding excessive leverage when everything is rising. It's not confusing a bull market with investment genius. It's recognizing that prudence during euphoria is what allows action during panic. Warren has built an entire philosophy around the idea that successful investing is fundamentally simple, though not easy. Simple because the principles are straightforward. Buy good businesses at reasonable prices and hold them. Not easy because it requires going against human nature, against the impulse to act when everyone acts. against the fear of looking foolish before consensus. Observing the signals of an imminent crisis is useful not to speculate about when it will arrive, but to remember that it always arrives. That cycles are inevitable. That collective euphoria always ends in collective tears. And that whoever builds their strategy assuming this time will be different is building on sand. For Warren, the most valuable lesson from having lived through multiple crises is that surviving them requires mainly not doing foolish things before they arrive. It requires not betting the future on the present. It requires not confusing volatility with risk or popularity with value. It requires understanding that the market is not there to serve you information but to serve you opportunities, and that the best opportunities arrive when everyone else is paralyzed by fear. The signals are there, repeated with almost predictable regularity. The question is not whether you'll see them, but whether you'll have the courage to act accordingly when doing so makes you appear excessively cautious, outdated, unable to understand new paradigms. The discipline of remaining rational when everyone loses reason is perhaps the most valuable skill in investing, and also the rarest. Warren has learned that you cannot save those who don't want to be saved. You cannot convince euphoric crowds they're walking toward a precipice. The only thing you can do is keep yourself away from the precipice, wait patiently, and be prepared to act when sanity eventually returns to the system. This is the essence of his perspective on financial crises, not as unpredictable events that strike without warning, but as inevitable consequences of repeated human patterns. Whoever studies these patterns, whoever recognizes them when they emerge, whoever has the discipline to act according to this knowledge even when it's unpopular, has a decisive advantage not from knowing more, but from doing fewer foolish things in the critical moments where most commit them.